Hey there, my name is John Stevenson. Welcome to the Guaranteed Retirement Guy Show. Today we're going to be talking about annuity mortality credits and how they beat the 4% safe withdrawal rule. Okay, so if you have an advisor or maybe you're just doing research online, you probably have learned about the 4% safe withdrawal rate. And basically this is the notion of you can take 4% out of your account without depleting it before you pass away. And it'll last you the rest of your life as long as the investments inside the portfolio, as long as they grow and as long as they perform the way that you're planning for them to perform. And so when this rule came out, markets were a lot different. And so things have changed quite a bit. And so a lot of people are saying the 4% rule is out. It's more like 2% or 3%. So there are a lot of factors, a lot of things that can change this for you. But if you're looking for retirement income, you want to make sure it does not run out. And you want to make sure that you're kind of protected against some of those market downturns, because it's not a matter of if, it's just when. Then an annuity contract might make sense. Okay, so hear me out. I'm going to show you some options. Obviously, I sell annuities. But when I sell annuities, I'm showing lots of options, hundreds and hundreds of options for people to research and then decide for themselves. That's why I always tell people, go to my website, johnstevenson.com, check out my calculators, look at the annuity payouts. If you're looking for the highest income, check out the income rider calculator. That will give you typically the highest annual income payout. And then if you feel comfortable at that point, reach out to me. There is a link below this video and there's a link on my website, johnstevenson.com, and you will be able to book a call with me right there. So it'll be a Zoom meeting and I'll share my screen and we'll talk about all the options, and I will answer your questions. So, all right. So there's a few things that I wanted to chat about on this rule. So basically what happens with an insurance company is they pool the risk together. Okay. So when you have annuities, you have thousands of annuities, tens of thousands, even hundreds of thousands of contracts, and all of them pay lifetime income. But you might have some people that live till 100, and you might have people that live till 70, live till 80. Pooling this together, it allows the insurance company to be able to provide that lifetime contractual guarantee and give you a much higher than 4% safe withdrawal rate. And they don't run out of money, and neither do you. And it's great because you're transferring the risk over to the company instead of you having to take that risk and trying to churn out that income using the safe 4% withdrawal rate, which oftentimes does not work, especially if you talk to people that were using it in 2008, in 2020, 2022, in the dot-com crisis. I mean, over time, yes, stocks absolutely outperform and they do great. But when it comes to retirement and you're retired and you have the income coming in and you're counting on it, it can be very, very stressful. And when we are retired, we don't want to be stressed out about our money all the time. We'd like to enjoy the money we've accumulated instead of always just be watching the stock market every day. I have so many people reach out and they're like, I just want lifetime income. I want contractual income. And I'm sick and tired of waking up every morning wondering what the market's doing. I just don't want to do that anymore. So there's value to both. And in my opinion, you can have both. You can have growth in the market and you can have an annuity contract that's providing you the income that you need and still have the growth in your other accounts. So it's nice to be able to have that mix so that you can have the best of both worlds and have the peace of mind, but still have the growth and be able to take part in the action if you so choose. All right. So I'm going to share my screen. And we're going to be talking about different options with these annuities and why they beat the 4% safe withdrawal rate. Okay. All right. So looking at my screen, I put someone in here in Utah, $500,000. It's a male and it's a single payout. Okay. Let me just change this to joint because it's always going to be higher if you're a man and if it's just a single payout, because the insurance company is only on the hook for one life. And let's face it, us guys, we statistically don't live as long as females. And so because of that, they will pay us a higher amount. Okay. So we're going to base this now off of a married couple, and they're both 54. I'm just going to make this easy and simple. And they're going to wait to take income until age 62. Okay. They got $500,000 and they're like, all right, we do not want to subject this $500,000 to market risk anymore. We want a contract. We want a pension. And what are the best ones out there? And so, and it might be pitched a product, from their advisor that they think might be good, but then they start looking around, they realize there's a lot more options out there and often paying a lot more. Okay. So looking at this one, this couple, they are taking income in 8 years. They're going to take Social Security, and let's see what it is. All right. So these are the highest payouts. We've got North American, Midland, Clear Spring, Erica Trust, Global Atlantic, Delaware. I have a ton of people calling me that their advisors are pitching this one. And then you got Corebridge, Nationwide. And sometimes Corebridge and Nationwide is on top. It really depends on the state, depends on either whether you take it as a single or joint. It just depends. Okay. Sometimes it depends on the time of the year, because sometimes they will choose to be more competitive and then not so much. Okay. So it just goes back and forth. A lot of these top carriers will just kind of switch spots. I just seen over the years, a lot of the main ones, the bigger ones will switch spots more often than not. But even when you look at all these, I mean, the top, 10, they're all pretty close. Okay. So if you look at the highest one, let's just look at North American. So we'll talk about how this one works, and we'll look at the withdrawal rate. Okay. Because we're trying to beat the 4%, right? All right. So for this one, it is, let's see, $500,000. They're paying you, let me just double check here. They're paying you 8% compounded roll-up rate right here. Okay. So you go up here and say, okay, they're paying me 8%. That will grow my benefit base to $925,000. So you might be thinking, well, they took $500,000 out and they are missing out on the stock market return. Yes, they are, but they're getting an 8% compounded roll-up rate in return. Yes, it's not an actual account value growth, because let's be totally transparent here. This does not grow a lot. You see here, 500 maybe to 580. It's not, or maybe 600. Okay, so 600,000 after 8 years. Yeah, big deal. Obviously, they can make way more money. They could double that, right? Well, if you look at the benefit base, it's almost doubled anyways. Benefit base is $925,000, and that is your sole goal is income anyway. So you can leave it in the stock market and try to grow it to $1 million and then turn it into income, or just put it in an annuity contract that gives you 8% compounded that's guaranteed, and you're almost at that $1 million anyways, and it's guaranteed. Okay, so it's $925,000 multiplied by 6.9%, giving you $63,857 a year. Forever. Now, how's that for a safe withdrawal rate? Pretty good, huh? Now, what you have to realize is this is a pension. This is a guaranteed pension. Okay, it's not a legacy product. There are other products for this. If you want legacy, I can sell you one that gives you a lot of growth, a lot of market protection, and it's not really for lifetime income. You can use it for income if you want, but it's not guaranteed. Okay, but for this, it's guaranteed. You're buying a pension. Okay, and it's going to pay you 6.9% guaranteed. I love this. So contrast this to leaving your money in the market. And you might be thinking, well, I'm just going to make as much money as I can, but I still want a 60-40 split because I'm close to retirement. So hopefully I'll earn 7 to 8%. Okay. And then hopefully my account value will be worth between 900 and $1 million, right? And hopefully the market won't take a dump right before retirement, and I got sequence of returns risk. That would be a problem, right? You could do that, and you can absolutely turn it into income, but at the end of that 8 years, are you going to multiply that against what, a 4% safe withdrawal rate? Okay, that's fine. What are you going to get, like 30 to 40 grand a year, right? Versus this is giving you almost $64,000 a year guaranteed, because you got a safe withdrawal rate from the annuity of 6.9%. That's pretty good. So now the balance runs out. See that? That account balance will not last beyond your mid-70s, okay? And it's designed for that. It is not designed for legacy, okay? If you die early, you and your spouse, there's a death benefit. It's the account value, okay? So that's very simple. You're leveraging 500 grand to, what are you doing? You're leveraging for a $2.1 million pension. That's what you're doing, okay? You're not doing it for growth. We already established it. You stick in the stock market, you're going to do better, right? Fine. But there comes a point where we'd like to actually use our money and enjoy our money, but still get a decent amount of return until we use it. Well, this is one way to do it. You can put it into a contract with a good company, like we're showing North American. They're 126 years old. They're A+. They're solid, okay? You look at this and say, all right, well, this is pretty good. 8% compounded roll-up for my benefit base. Yes, my account value doesn't grow very much, but I'm not doing it for that, okay? And my lifetime withdrawal rate is 6.9, almost double the 4%. All right. It's a no-brainer when you're looking for contractual guarantees, and especially if you're thinking, I'll leave my other $500,000 in the stock market. I'll let that grow, double, and I'll buy more contracts later. That's a lot of people will do that. Okay. But for this, you're setting yourself up for a $64,000 pension, and maybe your Social Security is $30,000. You're at $94,000 in guaranteed income. Okay. That's really good. And then if you got your other $500,000 that's sitting in the market that's growing, okay, well, by then it's probably grown to 1.2 million. You might strip off another 200 grand and buy yourself another $20,000 in income at that point. See, it's a really nice to be able to compartmentalize these things. If you're using your money in the correct way, use a portion of it for the guaranteed income. Okay, that is what that's for. That's it. Okay, and then you got the rest of it for growth and for liquidity and for other things. Like it's really nice to be able to do that instead of trying to just mix it all in one, do a 60-40 split and say, all right, hopefully it works out. My advisor says it's going to be great and he's charging me 1%, so I got that too. And he says I'm going to be able to do this, and according to this simulation, my money is 93% chance that I won't outlive it. Like, you can do that, and there's nothing wrong with that. Those are great tools to use. But this is just a contractual guarantee. You know what it's going to be. Like, there's no surprises, okay? Like, if you look at this, again, if you take it at 62, it's multiplied by 6.9. But let's say you take it at 60. You can see it, unless you take it earlier. If you decide to retire earlier, you just let that benefit base grow for not as long. So now it's 793,000 multiplied by 6.7, still higher than 4%, and it's giving you 53 grand. So it's very, very flexible. And if you decide beyond 8 years, you're like, well, at 62, I don't really want to, I'm going to wait. It'll be another 8% compounded after that, and a higher withdrawal rate, probably 7%, I'm guessing. So I'll just bring that out one more year. So again, check out my calculators. Okay, this will give you the raw numbers, and then you'll be able to know for yourself if it works out. All right, so for this, it grows 69,965. And for those of you who are confused about these two symbols, North American, Midland, they're sister companies. They're completely separate, but they're under the Salmon's Financial umbrella. That's why they look similar as far as their logos. All right, so go back here and say, okay, the annuity has grown almost to $1 million. 9 years, pretty good. And look at that, safe withdrawal rate, 7%. Okay, I call it safe withdrawal rate, but it's just the lifetime withdrawal rate. That's what it is. So, and if it's a single payout, guess what? It's going to be higher than 7%. Yeah, because they're only on the hook for one life. We're only looking at joint payouts. Okay, single payouts are higher. So again, if you decide to wait one more year, because you might decide, hey, I like working and I don't really want to take this income right now. Fine. Wait another year, you got 999,000 multiplied by 7%, giving you 69, almost 70 grand per year for the rest of your life. Pretty nice. All right, so I hope this has been helpful. I just wanted to just kind of paint a scenario and an alternative to what you might be doing right now. What you might be doing to try to keep your money around for as long as you can and never run out, and be able to have the income you need. There's a lot of moving parts with that. With annuity contracts, they're very, very simple. You buy a contract, you get lifetime income, the end. Okay. It's really that simple. They're boring. Yes, I know they're not as exciting as SpaceX or the stock market. Absolutely, there are other things out there that are really fun to be a part of. I love those too. But it's a lot easier to do those things if you want to be risky. It's a lot easier to do that if you've got guaranteed income like you had in your 30s, right? You had a job and things are going great and you're making money and market goes down and it's not a big deal, right? Well, when you have annuity contracts paying you income, it gives you the same feeling and allows you to be, in my opinion, a better investor. You're less emotional when the market goes down. Not saying you wouldn't be emotional, but at least you got the income coming in. You can't cancel those trips, right? You don't have to cancel those trips. You can go on vacation. You can go see your grandkids. You can do whatever you want to do. Whatever your plans were, you don't have to cancel your plans, okay? Because you already set up your guarantees over here, which allows you to be as risky as you want over here. So anyways, that's my philosophy. It works really, really well for a lot of my clients. They get to enjoy the best of both worlds. So if this makes sense, if you have questions, reach out, comment below. Make sure you like, subscribe, share. And if you're looking to purchase an annuity, I'd love to help you. There is a link below this video. We can get on my calendar. It'll be a Zoom meeting and we'll chat. Otherwise, go to my website, johnstevenson.com, and you can book a call with me there. But I always encourage people, check out the annuities that are available. I mean, my calculators on my website, they're not as pretty as what we were just looking at right here, but they will give you the raw numbers, okay? They will give you the same data. It's pulled from all the carriers, and then at that point, you'll be able to have the information at your fingertips to kind of decide what is best for you. So anyways, hope that helps. I hope you enjoy the video, and we'll see you next time.